Market Gauge Chief Strategist Michelle Schneider joins us now for some insights. Michelle, we'll talk about the Fed in just a bit, but we got that historic move from the BOJ. Can Japan steal some shine away from Wall Street, you think?
Well, there was definitely anticipation that it might have a negative result on equities in the U.S., having eliminated any kind of zero interest rates or negative interest rates. And they've made other announcements that were interesting, like discontinuing the yield curve controls, which they were keeping yields low for lending and for encouraging consumption. But they didn't say anything about future rate hikes. And I think that's what our market heard, was that they weren't sure this would be a one and done, but there wasn't any great fear that Japan would continue in its rate hikes in the immediate future. So instead, the focus became back on the U.S. and the big meeting that we have here tomorrow.
Yeah, and that is the focus indeed for Wall Street. They're not expected to move this time around, but a lot of attention will be put on the commentary that we will hear from Fed Chair Jerome Powell. But how about you, Michelle? What are you looking out for? What are you expecting?
Well, it's been a very interesting year because there actually has been somewhat of a no landing scenario in that the level of federal funds and the level of inflation are somewhat normalized, which is why there has been so much buying in the market, that, of course, along with a lot of corporate buybacks. But this sort of liquidity that has rushed into the market at record levels is because right now people feel that in some essences, we can say that the Fed has done what they needed to do in terms of capping inflation. And even though those inflation numbers have come up, I don't think that there is anywhere at this point, except maybe if oil continues rallying, that people are afraid that we're going to accelerate inflation. So if everything stayed the way it is right now, basically what I would expect the Fed to do at this point is keep the status quo. I don't see any reason why they would want to upset the apple cart with the market at new all-time highs. Many of the sectors may show some cracks, but nothing that has really been catastrophic to the overall equity market. And of course, with the economic recovery here, no real signs of recession, even though GDP has basically grown on the heels of government spending more than anything else.
Yeah, you mentioned there that while we're seeing gains for the U.S. markets, there are parts of the markets that seem to be showing some cracks. So what are these cracks that you are seeing and where are they?
Well, I'd say probably the major crack would be in the commercial banks, because if you look at that sector, it hasn't fallen apart, but it hasn't rallied. And we know that there has been help by the central banks to the commercial banks so that they haven't necessarily gone into disaster, but they have been downgraded this year. And the commercial real estate is definitely not the greatest area of the U.S. economy, and I'm putting that mildly. Mm-hmm. And so we know last year in March, we had that little mini crash when some of those banks started to fail. And here we are back in March at a year anniversary. It seems like we've gone through it, but nonetheless, it's certainly something to keep an eye on.
Yeah. How much of a move do you think, or a driver or central bank action right now versus earnings versus AI and the exuberance around technology? What would you say would be have been the focus for the market moves?
Well, Sarah, I think you hit the nail on the head. I mean, clearly AI and tech and growth stocks have been and still continue to be where people are pouring money into. And they're hearing nothing but higher calls for stocks like NVIDIA, 1,200, 1,300 and on up. So there's been sort of a fear of missing out in terms of retail investors piling in. As far as the rest of the market, I think the biggest controversy, besides obviously the banks, would be what's going to happen in the retail space, because we've seen consumer discretionary pockets of it doing very well, while others not so much. For example, even in the staples, Dollar Tree is basically going out of business, closing thousands of stores in the U.S. So I think a lot of what's going to happen, and may even affect the AI stocks as it gets more and more saturated, is can the consumer keep up with everything that's going on? And the good news is household spending has increased along with household wealth. But at the same token, we're not necessarily seeing it spill over into the retail space as one might imagine with tech being so strong.
Yeah, and with this environment, Michelle, where are you putting your money in? What's the strategy right now?
Well, for us, we've had a very great year following the momentum and following the leaders. And this has been a year where following the leaders led the market, and it was a smart strategy. At this point now, we're taking some profits, and we haven't necessarily added into that area. We've been also heavily into home builders, which seemed like something that wouldn't do well, but it's done extraordinarily well. And other than that, in terms of where we're putting money, we're starting to put money into the commodities markets, particularly silver, gold miners. Obviously, oil has been a lot of fun. And in terms of other asset classes, right now, we're kind of on pause as we're waiting to see whether or not this tech rally continues and it filters money into some of these other sectors like retail and transportation. And the other big place has been the influence of the diet drugs. That has a huge influence in terms of certain stocks that are related to people who are finally going to be dealing with obesity in a way that might actually help longer term, not just the drug companies themselves like Novo Nordisk, but even some of the other companies that have to do with beauty and skincare, e.l.f. being a big hot stock this year. So these are all things that we're letting go. We're not necessarily jumping in more. And at some point, the other area that I think might be a very interesting investment would be what's been beat up really badly, which would be alternative energy. As oil gets more expensive, we've seen in the past that money starts to go back into solar and wind and possibly more into EV, which has been a really big beat up sectors this year. So that's another thing we're waiting to see if that stabilizes, and then I think that might be a good opportunity.
All right, I appreciate your thoughts today, Michelle Schneider, there, Chief Strategist at Market Gauge.